Hi, everyone, and thanks for joining us for another session in CoinDesk's Institutional Crypto webinar series, in which we focus on the developing market infrastructure for institutional investors. Today, we're going to talk about one of the most fundamental aspects of any market, and that is liquidity. We're going to look at what we mean by crypto liquidity and the role that the different segments in the market play in building that. We're going to talk about the relatively opaque OTC trading, the fragmented derivative markets, the role of institutions, and much more. And to do that, we're joined by someone who not only knows so much about how markets work, but who has played a pivotal role in building both crypto infrastructure and liquidity, and is helping to push it forward. I'd like to welcome Max Boonen, the co-founder and CEO of B2C2. Max, thanks so much for joining us.
Hi, everyone, and thank you, Noelle.
Before we dive in, I'd like to remind everyone that this session will be recorded and uploaded to our website as soon as possible. And I, for one, am going to be grateful to that, because every conversation I've had with Max, I've come away with a feeling that there's just too much information to absorb in one sitting. And those of you who've joined us for other sessions, you know the format. Max and I will talk for about 40 minutes, and we have a lot to get through. I've given Max the list of questions that you sent in. Many thanks for that. And he'll choose a few to answer at the end. And so, without further delay, Max, could you start by telling us what B2C2 does and how it got started?
Yes, thank you very much. B2C2 is one of the main market makers in the space. And what that means for those who are new to this is that we are connected to a lot of exchanges, and we provide two-way prices on those 24/7 on a continuing basis. Meaning that when someone buys or sells from the likes of Bitstamp or Coinbase, oftentimes they transact with us or with other market makers, as obviously we compete with others. So that's the first business that B2C2 started into. And then as the market developed, we went into the OTC business as well. And the main difference being that when you trade OTC, instead of meeting on an exchange, you trade bilaterally. You agree a price of exchange. None of that is public, and you trade on a known basis. You know who's on the other side of the trade, whereas on the exchange it's fully anonymous. So those are the main differences. And B2C2 has been a large market participant in the space since now 2015. Yes.
And when did you start the OTC operations?
Early on, actually, in 2016, we built the first single dealer platform in the space, because coming from conventional markets, we knew that our template for crypto was essentially the foreign exchange market, and the foreign exchange market has gone through significant transformations over the past roughly 20 years. And essentially, I'm talking about electronification here. So the OTC market in effect is where most of the action is happening now. There's a lot of reasons for that. We can talk about that later on, but we thought that the crypto market was going to go through exactly through the same process, meaning that the exchanges themselves, the likes of Kraken and Gemini and others, would turn over time as experts in distributions, in gathering those big user bases that make them very valuable. We've learned that Coinbase has more users, more clients than like Charles Schwab, etc. And that the liquidity question, the execution problem, would slowly move away from the exchanges and towards an OTC market. And so we've tried to be at the forefront of that effort, and that's why since 2016 we thought, hey, this is going the way of the FX market, this is going OTC, so we want to be a part of it.
I have a lot more questions to ask you about that further down. I do want to talk more about the development of the OTC market relative to the exchanges. But before we get into the weeds of all that, I'm sure everyone wants to hear your take on the Bitfinex news. Is it a big deal?
Yes, of course, we need to talk about that, because we're not really here to talk about B2C2. This is very momentous in my opinion. Now, opinion is very divided, and we've known for a long time that some people believe Tether is sound, others believe it's a scam. I think we need to keep a cool head here. On the one hand, something I want to get out immediately is that I do believe that the team at Bitfinex is acting in good faith. It doesn't mean that they've always made the right decisions, but I do think that they're acting in good faith. And I say that because I know some of them personally and hold them in high regard. Now, I think that what we have now with Tether is a conflict between the old ways of doing things and the new ways of doing things. And I will dig a little bit deeper here. In conventional markets, we are used to relying on a network of professional firms that keep some level of order in the marketplace. I'm talking about audit firms, legal firms. Some of them are very big and respected. And that's the private checks on the structure of the market. On the other hand, you have the regulators.
They're often there because the regulators insist that they do that, right?
Of course, on the other side, you have the regulators, that's the public side, but the regulators can't do everything, nor do they want to, and so they rely on the public side rules that they put in place, but then on the private side on checks that are performed by audit firms and others. Now, when you're a bank or a hedge fund or something like that, it's very straightforward. You tick some boxes, you follow the right processes, and then there's a firm that's going to audit you. And then because you're audited, the regulator is satisfied that you've ticked the box, which is auditable, right? Now, the problem with crypto is that the audit firms and other professional firms, they just don't want to have anything to do with it. And for better or for worse, it's a free market, so they're free to do what they want. I think it's a bit of a failure of the market in this case, but you can't force a big four company to audit a crypto company. They don't have to if they feel that the risk is too high. Now,
why would the risk be high? What are they afraid of? Well,
I think a lot of it comes down to the fact that they were embroiled in a lot of scandals recently, and it's like three strikes you're out. In the UK, the regulators are talking about breaking up, or the legislator rather, are talking about breaking up the big four accounting firms because of the conflict of interest inherent in their business models. It's not all rosy on that side, right? But at the end of the day, it's not like the regulators could replace the audit firms overnight. So what you end up having is that everyone in professional services, especially since September 11 and the global financial crisis, everyone's very conservative. And here we've got a new market where people need to kind of get a little bit outside their comfort zone. And what's crazy is that I actually was with David Mercer, the CEO of LMAX Exchange yesterday, and he said on the panel that his firm has to be regulated, has to be audited because it's regulated, and his auditor, I won't name them, they simply refuse to audit the crypto balances. So bank accounts, processes, whatever you want that's normal in the conventional markets, fine. But the crypto balances themselves, they refuse to say that they were there. How crazy is that? You and I, we've been in crypto for a long time. We know that, in 5 minutes, you can check whether, some coins actually are on an address or not, right? And we know how to prove ownership of that.
The easiest part of the whole business to audit is the crypto holdings.
Exactly. Yet that's exactly the part that they refuse to do. And so I think that when you go back to Tether, I think that they would be more than happy to be audited. And the problem is that there is no amount of money that they could pay an accounting firm in order to go through that process. And the problem here is that, there is no way for us to know because there's no audit, that the reserves are actually there or not. I happen to believe that they are there. I mean, obviously what happened yesterday, muddies the picture significantly. But at the end of the day, it is not possible for the market, for private participants, to come and tell us, hey, yes, the reserves are there or they're not. And so what is really ironic, in fact, with what's happened is that the New York AG is now telling us, so they're not enforcing against Bitfinex. They're not giving them a fine yet or anything like that. They're trying to freeze things so that they can dig and get to the bottom of this, right? And it's very ironic that, the market has been unable to come to a conclusion as to whether, Tether is fully backed or not. And it's going to be quite possibly the authorities, the government, the state, that's going to come and tell us whether it is the case or not. And I think that in a way, that's a good thing for the industry. It's obviously not very good news for Tether in the very short run because it seems like, they turned some very liquid reserves into reserves that might be less liquid or less certain because of the whole crypto capital conundrum. So that may be a problem for the companies themselves. And I hope not, but they may not be there in a few years. But on the other hand, at least we're going to get certainty. Hopefully the regulators will tell us what is what, and then we'll be able to move on as an industry. And I hope that it's also going to give us a way to move forward, and perhaps with other stable coins and how we could create a new Tether or find a successor that will be built on a foundation that hopefully perhaps depends less on those network of professional firms that I've been talking about. And by the way, that also includes the bank, because at the end of the day, the reason that Bitfinex has run into difficulties is because it is very difficult for a crypto company to get access to the banking system. None of this would have happened if, let's say, the Wells Fargo issue a couple of years ago hadn't occurred, right?
Yeah, that's very true. And it's interesting that the New York AG announcement or investigation is going to, on the one hand, clarify how these types of businesses work and we get it more out there. But on the other hand, it is going to increase uncertainty. So it'll be interesting to see whether this does encourage banks and auditors to be willing to work with crypto firms or discourage them.
Yeah, well, sometimes the authorities need to step in and force the market to step up. We've seen that, with banking actually, it doesn't really apply to companies, but there are a bunch of laws in different countries that if you're a person, a bank has to open an account for you. It's about banking the unbanked, right? Like, it is unacceptable in this day and age that individuals don't have access to banking. To me, it's an essential, human right, because you can't participate in society if you don't have access to banking as an individual. And so, governments rightly, realize that and legislated in that direction. And, perhaps that's something, we need something like that with crypto.
Yeah, and the economic growth that could unleash, not to mention the innovation.
Mm-hmm.
I could talk to you a lot more about this, and I'm sure everyone has a lot of questions. No doubt we'll be seeing a lot in the media, including in CoinDesk over the next few days, dissecting what the impact this could have on the market. But again, we came here to talk about liquidity, so let's move on. I want to dive into the weeds a bit about the OTC market. And B2C2 has been around for a while. In 2016, you said you started your OTC desk. What's the biggest change that you've seen in the market since you began?
Definitely the electronification. Back in the day, and I think started from probably 2015, the first OTC desks started popping up. But initially, it was all about voice trading. And, a bunch of wealthy people, crypto wealthy people as well, decided they want to do something OTC. So they started, brokering big trades, matching people up who wanted to trade larger sizes to minimize market impact by agreeing transactions off exchange. And that's voice trading, voice brokering.
And they could do that. They could do that without any licenses or without any regulation, right?
For the most part, yes. It obviously depends on the jurisdiction, but you have to remember that when you look at the FX market as a comparison, most of the FX market is not regulated, right? Or if it's regulated, it's on very generic provisions that have to do with fraud and fiduciary duties to your clients. But FX transactions themselves, cash FX transactions, are, at least in the United Kingdom, not particularly regulated. So yeah, that hasn't been a problem. I don't want to call that a problem, but there hasn't been a constraint or an obligation in the early days. Yes.
But FX derivatives are regulated, is that right?
Yes, necessarily. I don't really know of any major jurisdictions where you can just trade, any derivative you like and offer that to the general public without a license. So yes, crypto derivatives are obviously regulated in most of the world, and that's also why B2C2, went after and received a license from the FCA to do just that for CFDs in one of our entities. So yes, absolutely, we're moving towards a more regulated marketplace. And we're doing that through the derivative market.
Yeah, and one thing I've been trying to get my head around is how is the crypto OTC market different from the FX OTC market?
I think it is only dissimilar in the sense that it is younger, right? I think we're just, it's like FX in 2007, perhaps. So we're only starting to see electronification. We don't really have all the ancillary services that people are now used to in the FX market. I'm talking about things like prime brokers or prime of primes. Maybe that deserves a bit more attention. So in foreign exchange, or really any OTC market, right? It's not just foreign exchange. There's a big separation between execution and settlement. Execution means, just there are prices, they're displayed, sent to you in whatever format you want. Then you trade on them. That means that you're trading against someone, but then there needs to be, or maybe not actually, an exchange of money, an exchange of funds, a settlement. And in the crypto market, those things are often conflated. And I think that's a bad thing, but there was no other way we could do that historically. And in other markets, those things are separate. That means that if you're, let's say, a broker, a small broker, a few high net worth individuals who want to buy into crypto, then you can help them, trade, because you can take prices from from some other market participant, and then pass that on to your clients. But then you actually also have in crypto to do the settlement. You have to receive money from your clients, and you have to send them the bitcoins back or something like that. That's a big problem actually, because it's not at all like that markets should work. What you have in conventional markets is that you do execution with a liquidity provider or market maker, and then there is a credit provider. There is actually an entity, a company, typically it could be a big bank, prime brokerage at Goldman Sachs or JP Morgan, and they will stand in the middle of the transaction and make sure that everyone is good, for the money, right? In some markets, that's also called a clearinghouse, where it's more centralized than just every bank has its own sort of prime brokerage service, and that doesn't exist in crypto. So that's one of the main differences, but we will get there, surely. I mean, I can't imagine the crypto market in 5 years will not have intermediaries that only take care of the settlement without taking care of the execution itself. And that's going to make for a much more liquid market, because at the moment when you think of it, if you want to trade on Bitstamp, on Binance, etc., you need to have funds on all those platforms. That's not the case in any other market I know of. And so we need to be able to separate those two things, so that whether you trade on one platform or the other, it doesn't really matter, because you end up settling in the same place. That's obviously going to make markets more liquid, because there would be no reason then for prices to differ materially from one platform to the other.
And it will free up collateral, which you can use to actually invest in the markets, which will free up even more volume, etc. Is that right?
Of course, because at the moment, and that's one difference between FX and crypto, it is very capital intensive, very balance sheet intensive to trade crypto. I mean, the idea that in order to buy $1 million of Bitcoin, you need to send $1 million first to a venue, that doesn't make any sense really. There is no reason for that to exist. But the problem is that when the way to solve that problem in conventional markets is to rely on credit. So you want to buy something, but you're not paying for it upfront. You're paying for it later on. That's naturally, that's what we call credit, right? Someone is extending you some credit. In crypto, we're naturally averse to that idea, because crypto is all about, trustless, decentralized, be your own bank, fully reserved, and so people don't naturally like credit. Now, we have to come to a sort of middle ground, because credit is healthy for a market, and so we don't have to go the way of super highly levered whatever credit default swaps or CDO squared, but we need to find a middle ground, because it's going to be good for the market. It's just that it's taken time, because not everyone likes the idea in crypto. But if you try to if you don't like credit, it ends up coming back to the back door, be it with crypto derivatives on the likes of BitMEX and OKCoin, or because simply people actually start trading OTC, where you naturally have that extension of credit through the post-trade settlement process.
And the credit will spill over into leverage. How does the leverage in the crypto market compare to leverage in other markets?
So there's a bifurcation in the market here. On the one hand, you look at this, you can look at the CME, and B2C2 is one of the main market makers on the CME. We're talking close to 50% margin, right? So it's 2-to-1 leverage. That's really low, and you can understand. The CME doesn't want to take very high risks, and they don't want people to get liquidated every day. And on the other hand, you have platforms, and I don't need to name them. You can trade with 100-to-1 leverage, 1% margin. So you've got very high leverage and very low leverage, and that's because on the one hand, you have a clearinghouse at the CME. So if you don't pay, if you go bankrupt as a trader on the CME, then the CME is on the hook for that, right? Or rather, the members of the CME clearinghouse. Whereas if you get liquidated on, yes, and it's regulated. Whereas if you go bankrupt on a crypto native exchange, like OKCoin or anything like that, they use socialized losses and things like that. They don't really, and I don't like that. I mean, I think it's, if you believe in your system, you should stand in the middle. You should make good on what people are trading with you. But instead, they decided to use socialized losses, so that if anyone goes bankrupt and is not good for the money, because the market went against them too fast and they were not liquidated fast enough, then the losses are apportioned amongst the winners. I don't really like that, but that's one reason they're able to offer 100-to-1 leverage. It's obviously better if you want high leverage, but it comes with a cost, which is that, yeah, you may win, but it's possible that some of your wins get clawed back.
And when it comes to the leverage being lower on the regulated exchanges, to what extent do you think that has to do with a lack of familiarity?
Oh, very much. It's very much about lack of familiarity, and I think that there's only one direction for that leverage in terms of the regulated marketplaces. It's going to go up, right? I mean, we're going to have access to higher leverage. The only headwind against that would be if regulators themselves want to impose caps on leverage, which is also very possible, and has happened before. But I think that if you just leave the market on its own, then it's going to go towards it's going to go down towards higher leverage, just because people are going to get more comfortable. The way the CME and other clearing houses work, they have models, right? They have models in terms of how the market can move in a given period of time and how long it takes to do a margin call. And so as they fine-tune and hone their models, they're going to become more comfortable. Also, you have to look at the actual structure of the market. The CME is closed on the weekend, but the crypto market keeps trading. It's 24/7. It's actually something I really like. You can actually trade for an exchange to a crypto market during the weekend, because you can trade, Bitcoin Euro on one European platform and Bitcoin Dollar on the US platform, and voila, you have a Euro Dollar trade essentially. But at the moment, we're still in the old world on the CME where, everything's closed on the weekend, which maybe is a good thing from a work-life balance perspective. But that means that obviously they also have that gap, right? On the weekend, they close on Friday night, they open on Sunday night again. A lot of stuff could happen in that window, and so they necessarily need bigger buffers to protect themselves against that.
And as the regulators become more familiar with it, there might also be a possibility that they would encourage more leverage because a more liquid market is more stable.
So, I mean, from the perspective of regulator, I'm not sure they would directly encourage leverage, right? But they would, possibly, wink at market participants, say that they feel comfortable about the processes that are in place, that they believe that liquidity is also important, and so the extension of credit, aka leverage, is also very important. I don't think they will push for it directly, but obviously regulators are not there to just be party poppers, right? I mean they want this industry to be useful for the public. They just want to protect the small investors, and so if it's good for small investors, of course the regulators will be open to it.
Yes, because especially the SEC is all about capital formation. They actually want people to be able to invest in the market.
Yeah, and it goes back to things like ICOs, if they can ever be regulated. Of course, if there's a more liquid market for ICOs and things like that, it's going to make it easier for companies to raise funds under that format, which is going to facilitate capital formation and bring benefits to the economy and so on and so forth. Yeah, I think everyone's on the same page, but we can sometimes approach the same problem from different angles.
Yeah. Going back to the OTC market, what about volumes? How do OTC volumes compare to exchange volumes in your experience?
So I can really only speak to our own volumes, and I mean, obviously the exchange market is bigger than the OTC market. I mean, I suppose it depends how you calculate it, right? But more than 50% of our volumes are on exchange. We think that's going to flip sometime soon, but it hasn't yet. A lot of it comes down to balance sheet constraints. I explained that it can be very capital intensive to trade crypto, and so that's a bit of a headwind towards really growing OTC volume 10-20x. But we're really getting there. And I think that when you look at the overall crypto market, it's a bit difficult because the numbers are not public, right? And also the perimeter is a little bit unclear. If you trade on Binance, it's very clear what the volumes are because everything's published on the tape. But the OTC market, do you account for localbitcoins.com? If there's a broker, like let's say one of the actual regulated big retail brokers that we know of, if they have their own clients and they trade there, and then they trade on the exchange, is that really OTC? Should that be apportioned to the exchanges? It's a bit difficult to say, but I think that there's a general understanding that the volumes on the OTC market are not as big yet as the exchanges, but that's going to change in the future.
In favor of the OTC markets, more volume growth coming from there?
Yes, and that's what you see in conventional markets, right? Most of the volume in most asset classes is actually off exchange, even equities. People tend to know about the US equities market because we kind of grow up with the New York Stock Exchange and, oh my God, ringing the bell, and it's just like part of like pop culture, right? But in reality, it's a small market. The US equity market really is not a huge market compared to the OTC markets, especially like in government bonds and foreign exchange. And so we know of that one because it's pop culture, but in reality, most of financial markets are actually OTC. And what's very interesting is that in spite of regulators, after the global financial crisis, pushing towards more exchange trading, more central clearing, because they viewed, in some cases, OTC trading as a little bit more opaque and so more difficult to get your head around. We have actually seen not that happen at all. Like the regulators have been pushing, and that includes, higher capital requirements if you trade OTC versus an exchange, etc. Yet the market keeps going more and more OTC. Even on things like interest rate swaps, which I used to trade, the regulators want us to do central clearing of swaps, etc., but actually it's not really happening. So there must be, and I believe I know a few of them, strong economic reasons for a preference as a market to trade OTC rather than an exchange to some extent. I mean, of course, exchanges will always exist and have a place, and their place is important in an ecosystem. But there are strong forces putting us towards OTC trading, and so that's how I think it's going to evolve.
And what are some of those economic reasons?
Well, I'll use a very simple one. First, if you trade OTC, you get a price that is not a price that everyone sees. And that enables customization by clients. When you trade on an exchange, it's one size fits all. And that means that both from the perspective of the price taker and the provider of liquidity, you don't know who you're trading against, and it has to be on the same price, right? It's publicly displayed. Whereas in the over-the-counter market, you can give different prices to different clients. If you have a very good client, they're doing a lot of volume with them, you can show them a better price. And when you have, a client, not so much, then you can give them a worse price. And actually, it's not just a question of spread, but also a question of, hey, this client, I'm going to show a price based on $5,000 per Bitcoin. This client, I'm going to show a price based on $5,002, right? Why? Because I think that maybe, one of the clients is going to be incentivized to get me out of some risk or position that I have and I want to get out of. And so by skewing my prices to specific clients, I can actually achieve better overall economics, right? Because client A is going to sell some Bitcoin to me, and I'm going to shift my prices to some of the clients so that they will be incentivized to buy from me. And so essentially they will, get me out of my risk quicker, and I will be able overall to show tighter prices to my old client base because I'm able to get out of my risk quicker by showing, slightly different prices to different clients. On exchange, you can't do that. When you buy on exchange and you want to get out, the only place where you can get out is on the same exchange. And that makes things obviously more complicated. So the ability to show different prices to different clients is actually it's major. It's a major deal, and that's one of the reasons that there's value in an OTC market. It's not just about big sizes. In fact, most of the trades that we do are reasonably small. It's just that we do thousands of them every day, right? You can get better prices OTC, not just because you trade big sizes and so you can find someone else elsewhere who has the opposite interest compared to yours. It's also about the fact that even on small trades, that dynamic of being able to show different prices to different people based on characteristics and what you want to achieve, you can actually give better prices even on small trades.
I think that's a misconception.
Then of course there's the issue of fees.
Yeah, I think it's a misconception the market generally has, is that OTC is only for big trades. But you're saying that no, there are a lot of small trades done as well, because what they want is to be able to negotiate a price and know that that's the price they're going to get.
Yes, absolutely. It's much more complex than just trading big trades. I think it's because people started doing that we have that conception that OTC is about big trades. Not at all. In fact, I think that there's tremendous value in the whole value chain, including very small trades. Because when you think about that, if a client wants to do a very small trade, right, and you know who the client is, and you know that they're doing that small trade because it's like a remittance company, and so they need to convert some bitcoins back to euros or Philippine peso or something like that. They're not trying to push the market in one direction. They don't think that the market is going to go up or down. It's just part of their business model that need to transact in and out of Bitcoin or some other crypto. Well, if you have an exchange and you see one small trade and then followed by a flurry of 50 other small trades, then you're thinking, well, is it a remittance company or 10 remittance companies, or is it an algo that's thinking that the market's going to move and they want to trade against me, you know. So the fact that you can, you know, also understand the business model of the counterparties that you have on the other side of your transaction also helps sort of like fine tune your pricing to give something that is
Max, are you there? I think I lost you. If everyone can hear me, hang on a second, try and get Max back.
Noelle?
Okay, we got you back.
Sorry about that. So I was saying that, you know, OTC it's actually about value creation, because when you understand the business model of the people that you have in front of you, you can fine tune your pricing to give them something that's best for them. You know, it's like when you have, you know, it's like in normal business, right? You know, if you're a service provider, I don't know, you design a website, then if you understand what it is that the people on the other side are trying to achieve, then of course you can give them something better than some sort of like one-size-fits-all WordPress, you know, platform, right?
Mm-hmm. And how would the OTC market impact price discovery then? Would it?
Well, so it's very interesting, right? When the market is completely lit, as we said, you know, when it's all on exchange, then the price is just the price on the exchange, and that's what it is. And when it's OTC, you start having, you know, a price on the exchange and a price OTC, and those things are not always necessarily the same thing. So it, you know, in terms of price discovery, it depends what you actually mean by price discovery. I think that, you know, the clients that you're trading with, you know, they might not see the same price as the exchange, might be better, might be worse. So from that perspective, you know, what is the price of an asset at the end of the day? It's very difficult to ascertain, and actually that's a problem that the CME has had to solve in creating the index that they would use to settle the price. Others, like the Gemini exchange, have decided to use the auction for the CBOE futures. There's different ways of doing this, but when you think about it, the fact that there's a price on an exchange does not mean that you've got strong price discovery. Because as we've seen actually, well, yesterday when the market started tanking, you know, the prices between the Tether exchanges and the dollar exchanges went completely out of whack. Completely, I'm talking like several percent. And so it doesn't mean that those prices were sort of like fair, right? You know, or crypto futures also really tanked, and they went way lower compared to the spot price. So I mean, yes, you have a price and you can transact at that price, but is it really the right price when all the markets are like, you know, 5% from one another? I think it's a lot more complicated than that, and so, you know, I prefer to hold judgment. I think that what's important is that people are happy to transact at the prices that they see either on the exchange or from an OTC liquidity provider, and that's what's most important. And that there's competition in the space, so that, you know, you can't just, you know, give whatever price to your client. You know, they have alternatives so that they can go elsewhere and they keep you honest.
You know, in fact, the last webinar that we did in the CoinDesk Institutional Series was with Dave Weisberger of CoinRoots, in which we talked about exactly that, about price reliability and the information and the uniformity, or lack of, in the sector. It was very interesting. But staying with price discovery, what is the role of derivatives there?
Well, I think derivatives are very important in any market because they enable people to express views on the market without necessarily needing to transact in the underlying asset. And what does that mean? Here's an example. When you want to trade, or you're looking at the commodities market, like agricultural commodities, right? So what you have with agricultural commodities is that you've got on the one hand, you know, the farmers, commodity producers, they want to hedge their long-term production. They want to lock in the prices now, right? But they don't have the grains or the whatever it is yet, right? That the stuff needs to grow, right? So they necessarily need a futures market in order to be able to lock in that production. And in fact, that's something that's existed for millennia. The first futures or kind of contract that looked like a future was created in ancient Greece on the production of olive oil, because, you know, people wanted to lock in the value of their production without being, you know, dependent on weather and things like that that is unknown.
If they had to pay costs, they need to know what money they have to pay their expenses.
Exactly. Yeah, I mean, you need to pay farmhands and everyone up front, but you don't get to sell your production before it's grown. So you naturally understand how a future could be interesting for commodities, right? But now what's more interesting is that, well, if people think that the future prices are kind of out of whack and make no sense, then what do we do with that? I mean, if future prices severely depressed against what we think the commodity would fetch in the future, then what do we do? Well, I think that's when speculators come into play, because speculators are interested in finding like relative value arbitrages and trades like that. And so what you're going to have is, if the futures go too low, then you're going to have hedge funds that specialize in commodities. They're going to go and buy the futures up, right? And that's going to give you obviously a better price for the farmers that want to sell. And so it's important that you have futures. That means that you have like bona fide hedgers like the farmers, and on the other side speculators that can also take views on whether the prices are artificially depressed or too high. In fact, it cuts both ways. And so you have a healthy ecosystem that serves everyone. And so what's interesting with crypto futures is that now you have people that can express views without necessarily being really deep down in the nitty-gritty of, okay, I need to sign up on exchanges, I need to do KYC, I need to have a wallet, and that's quite complicated. And so I think that futures in this instance, they really help price discovery. Also, something else that they do is they enable, just like the farmers that we talked about, the producers of the crypto space to also hedge their production. And I'm talking specifically about the miners here, obviously, right? When you're a miner, you have future income that's going to be denominated in Bitcoin or some other crypto, but you don't exactly know how much it's going to be. You have like estimates, right? And so if you think that you're going to get 1,000 Bitcoin a month for the next 12 months, and maybe you sell some futures ahead of time to lock in your prices. And so that futures really help building a more sound ecosystem like that.
And we have various types of futures. You've got the cash-delivered futures that we have in the regulated exchanges in the U.S., but there's a strong market for physically delivered futures outside of the U.S. What impact do you think of physically delivered Bitcoin futures would have in the U.S. should that happen on the regulated exchanges that are working on it?
Well, I think both are interesting. What I find a little bit disappointing is that people feel very strongly one way or the other. I think we need to be more agnostic. There are pros and cons. And very simply, here's one. If it's a physically delivered future, then obviously that is like, the price is the price. At the end of the day, you deliver a Bitcoin, there is no uncertainty. Whereas on a cash-settled future, you don't really know. I mean, you depend on the methodology of the index, right? And so, you have to ascertain that it's a good methodology. But on the other hand, when you have an index, you know that the future is always going to settle. There's always going to be a price because we can compute the index. Whereas on the other hand, if you do physically delivered futures, you run into the problems of what we called settlement fails. And that was a big problem when I was working at in a bank. Is that sometimes people just don't come up with the asset. You locked in a price, you agreed to do a future or forward transaction, a month from now, and then when the day comes, you don't deliver. You simply have, I'm sorry, I know I sold the bond futures, so I'm supposed to deliver a bond. I just don't have the bond. Sorry about that. And then
what happens when that?
Yeah, I mean, very simply, it's kind of silly, but you have fines. You just get a fine. You get a fine
really?
from whatever exchange or the clearinghouse. You get a fine, but it obviously it reduces the certainty to some extent, because if on the other side someone really needs that asset that they wait for delivery, then it has problems down the line. And then regulators started looking at things like settlement daisy chains. It's like I fail on my settlement, then someone else fails on their settlement, and so on and so forth. And maybe actually at the end of the chain there's someone who's like actual solvency or liquidity depends on that. And that's a negative. But obviously it's not all good or bad. You've got like pros and cons. So I think it's actually good for the market that we're going to have both. Yeah.
And what do you think the miners would be more likely to use?
Well, I mean, it sort of depends. I think the miners, naturally, you would think they would like to use their coins to deliver into the contract. That seems natural. But on the other hand, some people also talk about the fact that when the miners mine fresh coins, those specific coins might have, higher value, like virgin coins or whatever people call them, or clean coins, I don't know. So that's interesting. So maybe the miners actually don't want to use those coins. There's a concept that's interesting in derivatives trading. When you have to deliver an asset, it's called cheapest to deliver. When you have a future, you can deliver different assets typically. So if we talk about bitcoins, if you're going to deliver some bitcoins into a future, you can deliver some old bitcoins that you have in a wallet, or you can deliver freshly mined bitcoins. And if the future accepts both, then you might as well deliver what we call the cheapest to deliver, so not the virgin coins. So in that context, perhaps actually the miners would use cash settled futures. I don't know. I think it's both are possible, and it's going to be just simply interesting, and we have to keep an eye on that.
You're launching crypto contracts for difference, or CFDs, in Europe, and if I'm not mistaken, you're the first to get the license from the UK's Financial Conduct Authority to deal in them. Why this particular instrument, and also can you tell us how these are different from futures?
Yes, I'm very happy about that development. So when you look at derivatives, there's few categories, right? The ones that we're talking about now, they're called 1 delta, delta 1 derivatives, which means that when you enter into the contract, it's as if you had purchased or sold the underlying, right? So when you buy a crypto future, it's like buying a Bitcoin. That's unlike an option. When you buy an option, you get a fraction of the exposure or something like that, right? So we're talking first about delta 1 derivatives. When you look at delta 1 derivatives, the second dimension is the term structure. It's whether there's a maturity to the contract that you're entering into. So when we talk about futures, it's very easy. On the CME, it's every month there's a contract, so it's a 1-month contract. On BitMEX, you have quarterly contracts. On OKCoin, you have 1 week, 2 week, etc. So that's interesting. There's a term structure element, but you can also have contracts that actually never settle. And sometimes people call those perpetual swaps, and I call them CFDs, contracts for difference. And the difference is that those contracts don't have a term. So the way they work is you enter the contract. So let's say you go long at some price, and then if the market goes up, you're going to make a profit that is the same or approximately the same as if you had simply purchased Bitcoin and then sold at the higher price. Now you don't need to put up the full amount when you want to purchase. That's why it's a derivative. There's embedded leverage in it, and the difference is that to sort of bridge the two is that there is a funding cost, or even sometimes a funding rebate, that is applied on the perpetual contract, on the CFD. So it's like when you think about that, if you buy a Bitcoin with your cash, you take $5,000 from your bank account, and then you buy the Bitcoin and you wait, you hope it goes up. Then obviously the fact that you're using your money, it's got a cost. It's at least an opportunity cost, right? What you can do instead is purchase a contract for difference, and then it's the same exposure, except you don't have to put down $5,000. Now, the reason that you don't have to put down $5,000, it's a derivative, and therefore you're going to pay for the fact that you don't have to do that through the funding. So maybe the provider every day we charge you like an APR, an annualized rate of some, I don't know, 2%, 5%, or maybe even give you a rebate depending on the sort of direction of the market. So that's how you bridge the gap. Whereas the futures, they trade at a different price from the spot, because they embed the fact that the price is different from the spot, can be higher or lower. That's how the funding element is represented. So when you trade an instrument like a CFD that has no term structure, then you will pay funding or receive funding every day, but you will transact at the spot price. So if you look at the CFD prices that we stream to our institutional clients, they're exactly the same as what we stream on physical transactions, and they're exactly the same as what you can find on like a Bitstamp or a Coinbase, right? Whereas the future necessarily trades at a premium or a discount, because that's how it embeds that funding element. So that's a very important difference, and the reason I wanted to start with CFDs is that I think it's easier for people to manage their risk when the product trades at the same level as the cash market. I don't think you want that basis risk, because the problem is if you buy the futures now at a premium and then they go down to a discount, then you've lost money even if the price of Bitcoin hasn't moved. And that's an extra risk, a basis risk as we call it, that you have to manage. And I don't want my clients to necessarily have to do that. I want to offer a product that is more specifically driven by the value of Bitcoin without like second order and third order effects.
So it's almost like a synthetic way to construct a portfolio.
Exactly, and you see that in various markets. Some people will want to trade futures, some people will want to trade CFDs, and I think that for the user base, for the client base that we have in crypto right now, I think CFDs are more appropriate.
And how do you think this might affect liquidity?
In what sense?
In terms of volumes coming into the market, would it affect the underlying Bitcoin market at all?
Well, yeah, I mean, yes, it does necessarily. I mean, if you have a healthy OTC market, I think it can also help, with the liquidity of the market as a whole. The fact that I trade with my clients and, they have some specific interest, that informs me in terms of what's happening with the liquidity of the overall market. When my clients start becoming very active, I get the sense that maybe it's going to become very active on exchange, or vice versa. When the exchange becomes very active, it informs me and tells me that it's possible I'm going to see a lot of client flow right now, because the market's moving, everyone is kind of reassessing what they want to do with their positions, or they're forming new views as the market is moving. Exactly like what happened yesterday. We obviously had very large volumes because there is that piece of news out there. Some people say that it's very negative. Some people say it's only mildly negative. So, people form new opinions. And if you think the price right now is too high, then you want to sell. If you think the price has come down to a level where it's attractive now, then you want to buy the dip, And so, that it is the fact that people form new opinions that gives you a market. And that, that's why people don't have the same opinion, therefore they transact. If everyone had the same opinion as to the value of Bitcoin, there would be no market.
And the more opportunities to express your opinion through the markets, I guess the more stable the end result will be, especially given the characteristic, equilibrium and reluctance of the crypto market to form quick opinions.
Absolutely.
One thing I want to ask you before we wind up and move on to the audience questions is BTC is an institutional desk, but what do we mean by institutional? I think it's a word that we use a bit too loosely. What does institutional mean to you? What kind of institutions do you deal with?
Yes, I agree. I think we use the word institution too loosely, and it's not really helping. What people need to remember is that when we say an institution, it is in most cases an institution that actually has a business model that serves the general public. Like, we talk about BlackRock, we talk about Fidelity, oh my God, they're institutions. As if those guys of their own volition were going to come and start buying Bitcoin and getting invested. It doesn't work like that. Institutions are things like pension funds, mutual funds, insurance companies. Why do those guys have money? They have money because in the case of a pension fund, there's a lot of people that pool their funds and they take like a portion of their paycheck every month and they put that in a pension fund. When you look at insurance companies, you have like fire insurance for your house. Every month you pay a small premium and that goes into the coffers of the insurance company. The insurance company doesn't pay you immediately. I mean, hopefully your house never burns down, right? And so they have all that money. But at the end of the day, the money that they have is because people, the general public, has given them that money, right? So when you look at mutual funds, that's obviously people putting their life savings into investments. And so what we need for institutions to come into the space is we need the general public to feel like there is a case for crypto. That is the main driver. There is no institution except perhaps some, high-flying and very aggressive hedge funds that will simply want to go and buy Bitcoin just for the hell of it. They're going to buy Bitcoin because it's going to serve their user base, for their client base. That, at the end of the day, that's what they're for, right? And so I think that institutional adoption is actually predicated on the desire in the population, to own Bitcoin or to have some exposure. I mean, it can actually be short for all we care, right? To the asset class, and that's what's important. It's not at all a matter of build it and they will come. I completely disagree with that, and I think that a bunch of exchanges actually learned that to their detriment. They built very good infrastructure, custody solutions, etc., and people are not coming in. And I think that's because they misunderstood that first and foremost, they need to cater to the general population. That's who they need to be speaking to and designing their systems for. I think that, and I want to actually commend them for that. I think that Binance has done a very good job of that. Binance is very focused on their user base, and we're talking like small people like you and I that want to invest. And so, they do things like, if you're a very aggressive trading firm and you want to take advantage of the prices, you want very fast connections, they actually don't like that. And I think that's, it's not necessarily a bad thing. If you just build a super fast exchange for predatory HFT trading firms, and I guess I'm also an HFT firm to some extent, so, I'm just trying to be very honest here. I mean, it's not useful. What's useful is when you have a healthy marketplace of, yes, of course, HFT market makers, because we need to bring the prices in line on all the platforms and trade OTC, etc. But at the end of the day, that's because we need people to be able to transact in and out of crypto efficiently and at a low cost. Same thing you saw in conventional markets with the rise of the ETF trackers. At the end of the day, ETFs are very popular because they cut out some middlemen and they made they made the investment process better and most efficient for everyone involved, including, like small investors. And I think that's what we need to focus on. It's a very bad idea to think that you're gonna generate revenue by, borrowing, kowtowing to huge institutions. I think at the end of the day, you first need to build a real case for the general public.
Get the narrative. You're right, because institutions, in fact, probably can't invest in crypto unless their clients are behind the idea.
Absolutely. I mean, there would be no business model. And actually, I used to work at a well-known bank. Not everyone likes them, but they're well-known. And it's also public that they started looking at what product we could offer in Bitcoin, right? But the first thing that they did, is actually speak to their client base. They said, okay, they went to their biggest client. They say, we're thinking of launching a crypto product. What do you think of it? And only after they got sufficient interest did they start feeling comfortable. Okay, we're going to do this, right? And the reason that we haven't had a big bank really come into the space yet, I mean, after the bubble popped, is because the interest that those guys had has come down a little bit. Just as the interest from everyone has come down a little bit as the price went down. I mean, and it's okay. It can happen. Hopefully, it comes back up, right? But at the end of the day, it's not like an institution is going to be convinced of the business case without regard to its user base.
Yeah, and I guess the business case is the end decider. It has to make money for them, otherwise it's not really worth it. They're not really in this for the mission.
Absolutely, they're not philosophically inclined, and I think that's a good thing. On the one hand, you need people that feel very strongly about crypto and to be, evangelists, and on the other hand, you need people that, coldly look at the business case and, try to provide a service in return for a profit. It's important because when you're too involved, emotionally speaking, in your space, then you can start doing the wrong thing. And I think we talked about recent problems in the crypto space. I think that sometimes we have a tendency as an industry to start forgetting about like you kind of lose your moral compass sometimes when you're too neck deep into your strong beliefs. And I think sometimes it's good to take a step back.
I totally agree with you. And speaking of taking a step back, I could talk to you for hours more about this, but let's try and get to a few of the audience questions before we wrap up. I sent you over the list this morning, and I'm going to let you choose which one you want to start with.
Yes, there are very interesting questions out there. I'm going to try to pick a few. I'm going to start with one I see now. The question is, do you concur with the Bitwise study? So I understand this is referring to not one but two studies recently that were published that said, hey, look, a lot of the volumes in the market are fake, and it was a very thorough analysis. It's very interesting. I think there's a lot of truth to it. Now, at the end of the day, you have different platforms that try to make a name for themselves in different ways. We know it's also a sort of like cultural differences between some countries where, in some places it's kind of okay to lie a little bit in order to get ahead, and maybe no one really realizes that you lied, and everyone is happy ever after, and no one knows that it's been a problem. In other places, it's like lying is a big no-no, end of question. And so what I look at in terms of fake volumes is obviously some exchanges are more legitimate than others, no question of a doubt. Then you have metrics, and the guys at Bitwise, rightly used. I think they did a very good job. One thing I look at actually, which is interesting because it's private information for me, is I actually look at my own volumes. If I look at the platform, and normally in Bitcoin Euro, I have like a market share of 15%. And then on some other platform, the same product, I have a market share of 5%. Like, that's kind of weird, right? What's the difference? And when you dig deep, sometimes you realize, oh, okay, I've got 5% here, 15% elsewhere. That pretty means that 2/3 of the volume is fake, So it's one thing that you have to be very mindful of as a market maker, and I guess also as an investor, right? Is, if the volumes are fake, it paints an unreliable picture of the actual liquidity of the venue, and so you have to be mindful when you do want to trade in size and you're at risk of moving the market, do you really trust your venue to be legitimately liquid, or is it like some internal market making desk, or is it some fake volumes? You have to do your own due diligence. But I realize it's not easy to do. Obviously, it would be easier if the regulators told us, you have to do this and that, and then you can trust them. We're far from being there yet, but I think, hopefully studies like the Bitway study push us in the right direction.
And the increasing attention to this will no doubt do quite a lot to clean up the market, increase standards.
Yes, and obviously I'm talking my own book. We've made a decision at B2C to go down the more regulated route, and so we hope that it's going to pay off, over time.
Can you choose another one?
All right. Yes. So I see. How do you think single dealer platforms like ours, I suppose, for streaming executable quotes will fare against liquidity aggregation solution? That's an interesting one because it's a problem that the FX market faces. So aggregators, essentially you get prices from 5 exchanges, you put them into one order book, and the client can get the best of all 5, right? Versus a single dealer platform like mine, where you just get the B2C2 price and it is what it is. Well, you actually find 2 things, right? One, going back to the problem of credit, it's actually not possible to trade on multiple exchanges from the same infrastructure, because you need to have funds on all the exchanges. So that's a big problem with that model. And we've seen that actually back in the day. It was very interesting. Talking about Bitfinex, back in the day, Bitfinex, and I remember because I proudly keep API key number 5 at Bitfinex. We were one of the first clients there. They used to let you trade on Bitstamp actually. So you were on Bitfinex and you can actually send orders to Bitstamp. Very interesting, right? But then they had to stop doing that because of the liquidity constraint. They had to maintain too big an exposure, too much funding on Bitstamp in order to be able to allow their clients to do that. So you see right there that liquidity aggregating solutions don't necessarily work from like a funding/balance sheet perspective. And there's a second reason, which is very simple. If I am one of 5 market makers streaming prices in an aggregator, if I don't have the best price, I will not trade. If I have the best price, I will trade. That means that I actually suffer, it's like an auction, I suffer from winner's curse. It means that typically when I will trade, it kind of means that my price is a bit too good. Like, why do I have the best price and everyone else is at a different price level? I actually can get picked off. And the fact that I can get picked off in that situation, it's going to mean that I'm going to show naturally wider spreads, because I need to protect myself against the fact that I don't really know if my price is right, because when I'm the best, it may be that my price is too good. On the other hand, when I am a single dealer, then I have much more control on the execution flow, and I have better control over whether I'm going to be the best pricing or not, and whether I'm going to be picked off. So that's a big difference, and you actually see that in the FX market. And some firms are well known for having been extremely successful at that. Some firms actually have stopped taking prices from aggregators and have limited the number of liquidity providers that they use, because when you do that, you get into like a symbiosis relationship again. I touched upon that earlier with the fact that you can tailor your price and your parameters to the client when you understand their business model. When you use fewer liquidity providers, you can actually get better pricing because they suffer less from that adverse selection, from that winner's curse. So you see actually that dynamic in commercial markets, that people have reduced over the past few years the number of liquidity providers that they use in order to get better pricing overall. It's kind of counterintuitive, right? But I mean, if this were easy, there wouldn't be money to be made, right? So that's an interesting dynamic.
And the race to the bottom. And the race to the bottom. But yes, we do have time for another one.
Yes. So very quickly. How much volume do you lay off or source from exchanges? That's an interesting question, because it hints at different business models when you talk about OTC desks, right? So when you trade OTC...
What does lay off mean for those of our listeners who aren't familiar with that?
So I interpret the question in saying, okay, you have a client trading with you OTC. What proportion of that do you actually turn around and sell onto an exchange, right?
Oh, okay.
Well, so you have a spectrum in OTC trading. On the one hand, you have the pure agency business where I'm just like a middleman. I try to get a price from other sources of liquidity. I show you that price, and I just pass on an order, and I charge you a form of commission. That's what the OTC desk at the exchanges do. I think it's well known that 8-bit a while back started an OTC desk. Coinbase also has some sort of OTC product now. So what they do is they purely intermediate, they take no price risk, and they charge a commission, right? So that's one end of the spectrum. And on the other hand, what you've got is what B2C2 does is purely trading as a principle. So when you trade with B2C2, you trade against B2C2. B2C2 is taking that risk, and it's not turning around and hedging that automatically in the market. Obviously, some flow that we see, we need to hedge more aggressively, and so sometimes that means hedging immediately in the exchange. Sometimes that means, as I said earlier, skewing our prices a little bit to incentivize other OTC clients to get us out of the risk, and that's the other end of the spectrum. And I really like that because I think that, I mean, agency model has a reason to exist, right? But what I really like is that when I show you my prices, I'm really putting myself out there. You can trade on my prices. I'm not relying on anyone else. I need to do my homework. I need to have the best systems in place from a risk management perspective to be able to 24/7 without interruption streaming you prices you can trade on, and that I hope are going to be tighter and offer better liquidity than what you can find on exchanges. And so it's that big spectrum where you find oneself. And so how much of the volume do we lay off on exchange? Actually, we don't ever take an OTC trade and immediately hedge it on the exchange. It's always a decision: are we going to try to get out passively, or are we going to try to get out of the risk OTC with other clients? So actually, the answer is pretty small. And I think that's one advantage that we have, because necessarily, if you get like the end of the value chain. At the end of the day, any price you see on an exchange, someone has to provide it. There's going to be a liquidity provider. And when you trade with a liquidity provider that acts always as a principal, not as an agent, not as an intermediary, you always get like the raw, unaltered price, if that makes sense. And I think that actually it's a better price, because you're at the very end of the value chain. But obviously, in order to get there, you need to be a big enough player to justify like big enough volumes in order for that to make sense for me. Like, I can't have thousands of clients. I have, it's more like hundreds of high value clients who all do big volumes. I wouldn't be able to have this business model where I need to tailor my price to everyone if I had, hundreds of thousands of clients. So that's
I wish we had more time. There's just still so much more to talk about, but we have run out of time. And I do want to thank you so much, Max, for everything that you shared with us today. I certainly have learned a lot, and I'm sure the audience has also. Max, where can the audience find out more about what you do?
Well, I think, you can just Google B2C2. You can go on b2c2.com. And I don't think, need to say more. I'm not really here to advertise. Also, that's important to me. But if you're interested, I think if you want, you will find us.
Okay, great. Thank you. And so thank you very much to you, the audience, for joining us today. Don't forget, this has been recorded and will be uploaded onto our website as soon as possible, hopefully next week, because I'm sure, like me, you're going to want to re-listen to it. And don't forget to tell your colleagues as well. Thank you all very, very much, and enjoy the rest of your day.
No, thank you very much for your thoughtful questions.